All right. Yeah, I just want to start off with why we're doing this. So, I was in the service industry for a very long time before switching over to real estate. So, I feel like I know a lot of service industry people, and it can be very tough with getting approved for a loan. There's a lot of questions that I feel like come up, especially with income. So we just wanted to touch on that. Um, a little background on me was just that I started off as a leasing agent in the real estate world, and then I just moved over to Compass like early this year. I still have a part-time job in the service industry. It's very hard to get out of, as most of you know. And yeah, I met Caleb actually, I think early last year, 2022 or 2020. And we basically, I needed to get a investment property. Well, I didn't need to, no one really needs to, but I really wanted to. And he helped me with that whole process. I was struggling hard with the process with my being self-employed. I was 1099 plus always having a W-2 part-time job. My income was looking really funky, went to lots of different lenders, and I had zero luck until meeting Caleb. And with Campus Jennings Group, he helped me with the process, and I actually got approved for a great investment property, West Logan, kind of Hermosa area. And I was very happy with it. So now that I'm a realtor, I want everyone to get to know him and work with him. But yeah, so we will be covering quite a lot today. Some of the things we're going to be going over, we're going to be covering what it takes to qualify for a mortgage in general, what it takes to qualify for a mortgage specifically with tipped income, and then at the very end, we're here for you for like any questions that you might have. Specific topics we're going to be going over, obviously credit score, big one. I get tons of questions on that one. Assets, debt to income ratio, and your qualifying income.
Awesome.
And let you take it over.
Thank you. Thanks, Michelle. Yeah, no, it's awesome. When I met Michelle, I remember her coming to us and kind of thought it was like her last shot at trying to get pre-approved to buy a property. And it's always awesome when we can help someone out, especially someone who thought they couldn't do it or was at the end of the rope. So what Michelle hit on here is basically when you're going to buy a home, whether you're buying an investment property or if you're going to buy it for yourself, no matter what lender you go to for a mortgage, they're going to look at these four things: the credit score, your assets, your debt to income ratio, and qualifying income. So I wanted to hit on these buckets here to dig in a bit. What we call these four things are compensating factors. So some can be stronger than others, some can be weaker. The ideal scenario is all four of these are strong, that you're strong with. But we can work with you if you're strong in a few and not the others and what have you. So we're going to go into it. So let's talk about credit score. So really the first thing we're going to do is pull your credit if you're sincerely like looking to get pre-approved now. And when we pull your credit, we pull from all three credit bureaus: Equifax, Experian, and TransUnion. And when we pull that credit, you're going to have three different credit scores. All three bureaus will give you a different score. And what we do then now is we average the three scores, and that's going to be your qualifying credit score. So in lending, typically we're going to need about a 600 or higher credit score. However, in some cases we can go as low as 580. Again, it kind of goes back to your compensating factors. If you have a 580 score, your other compensating factors have to be very strong to do that. And then as far as when you are getting a mortgage, part of it, your credit score not only goes to whether you qualify, but it's also going to have an impact on your interest rate when you get a mortgage as well. So a 740 or higher is like considered great, and is going to get you the best interest rate that you can get for your credit score. So that's some bits on that. Michelle, why don't you tell me questions that come up for you or things that you hear from your clients about credit score?
Definitely. I feel like a general question is always just, is it a hard or soft pull? Um, yeah, maybe you could just answer that
Yeah,
for.
so and here's the thing is this. It's a hard pull. And the way that it works is that when we pull your credit, it's considered a hard pull. It's a hard pull from a mortgage lender. It's different than if you get your credit pulled from a credit card company or from an auto loan place or any other. And a lot of people have reservations about getting their credit pulled and pulled, right, and rightfully so. But the reality is this: when you have your credit pulled as a hard credit pull, if you have decent credit, it's really a minimum impact on your credit score. We're talking a few points possibly dropped off of your credit score. Um, so often those that are really worried about it, it's nothing to really worry about. And now what you should worry about is if you're going to get your credit pulled. Like if I went to a lender and said, pull my credit, I want to get pre-approved, and then I go to the auto dealership, pull my credit, and then I go to a credit card, and they start to see, wow, looks like Caleb's going on a shopping spree. He's getting his credit pulled from every which way but loose. Then yeah, that'll have a negative impact. The other fact too is that there's a consumer protection law that when you get your credit pulled from lender A, Caleb, you have a 45-day window into which you can have your credit pulled from other mortgage lenders, and it's not considered an additional hard pull. So it kind of rides on that one pull. And that's to empower you to be able to shop lenders. Because if you thought, oh gosh, I went to Caleb and got my credit pulled and he quoted me at this interest rate, now I'm afraid to go to the other lender to see what her rate is. Like, the whole point is to empower you to be able to shop as a consumer. So 45 days, minimal impact, really. If you're getting your credit pulled, it's a minimal impact 45-day window. Okay.
That's great. So really, like, points dropping is maybe a few points.
I mean, again, it can vary. It could depend on your situation, but I haven't seen it more than 5 points dropped on it. But it really is. If you look at any kind of the way that the grading of your credit goes, that's like the bottom of least impact, right? I mean, really, if you really want to worry about your credit, the best thing you can do, pay your bills on time always,
Yeah.
and don't max out your credit cards. Keep them below 30% to the max. That's how your score is going to go up. If you're doing those things, getting your credit pulled from a lender is not going to hurt you.
Great. Yeah, and I'm really glad that you touched on the 45-day window that you have to shop lenders, because I was misinformed. I was thinking it was like a 90-day. So I'm glad we clarified that. And that is really great for people to be able to go, see what they can get and get it pulled multiple times. And it really only affects their credit. Like, it looks like it's being pulled just one time. Is that correct?
Correct. That's correct. So the way that the credit bureau is reported is as if one hard pull. Yep. So
Great.
any other questions on credit for you, Michelle, or I'll go on
Uh,
to the next piece?
I guess it's a little bit, so if you get a pre-approval and you've run the credit for
Mhm.
this, if you're like extending the pre-approval, do you need to run the credit again, or is there like a certain time where you don't need to run it?
Yeah, so the way that it works is that when we pull your credit, it is good for 120 days. So
Oh,
after 120 days, it expires. We will be obligated to re-pull your credit to make sure that your pre-approval is still valid. Or if you, let's say, we pulled your credit and you've been shopping for a home and now it's 100 days out and you finally got the house, you're under contract and we're not going to close, we're going to close in 30 days. Well, we'll have to re-pull your credit one more time if that 120-day window is up as well. So
okay.
120 days, and then it expires.
Okay,
Cool.
great.
And then the next piece that we look at on qualifying you to buy a home is going to be your assets. So assets essentially are, do you have retirement funds? What do you have in the bank? And what we look at is, do you have the funds to be able to put a down payment as well as cover the closing costs? So we source that by looking at your last 2 months of bank statements, or if you're going to be borrowing from a retirement plan, we'll look at the last quarter statement of that. And basically, we're going to look at and verify for the last 2 months you've had the money in order to cover these costs. We're obligated by law to source the funds. You can't have like a bag of cash and say, I'm going to use this money to buy a house. It has to have been sourced and it has to have been seasoned. And by seasoned, I mean it has to have been in your account for at least 60 days. And if it's not into the account, if money's moving in after that, we may need to have some letters of explanation and we may have to source those funds. We're going to have to know where that money's coming from. And the point is that when you buy a house, you're going to have a down payment and closing costs. A down payment can be anywhere from 3% down to 20% down. So we're going to need to be able to say, okay, you have those funds for down payment and closing costs. Any questions about assets?
I feel like I've had questions like a little confusion on assets. You know, if your rent is considered an asset, you know, paying your rent.
No. So we're not going to look at, I mean, now, the only time like for rent, we could use rent if we need to show that you've been paying your rent on time, but although rent though, typically we're not looking at your rent. Like, and that's not going to be counted against you as a debt either, because once you start a new mortgage, you won't, unless you're buying an investment property, we're not going to worry about you paying rent.
Right. So it's more like student loans, credit cards.
Well, no,
Uh,
the assets I'm talking more right now about the funds they have saved
yeah.
for, yes, and then we'll go into
Well,
the debts next.
yeah, I'm stepping ahead.
Stepping
Yeah.
ahead,
So
it's okay.
you have, if you have, yeah, any sort of mutual funds, say, I
Correct.
don't know, you're invested in any sort of like stocks or anything like that would
Oh
be,
yeah, I mean we've been seeing a lot of folks with what is that Robinhood accounts now, like the with stocks on that. If you've been getting stocks on Robinhood, like you get the statements, you can use those. You can use those to help you to cover costs if you need to. So
okay. Cool.
let's talk about then. You were kind of going
Yeah.
here is the
The
debt
next
to
step.
income. So we look
Yeah.
at, just to kind of recap. So we're going to look at your credit score. Do you have a passing credit score? Okay, great. You've got a credit score that qualifies. Assets. Do you have now the money for a down payment? Do you have the money for the closing costs? Okay, great. You have that. Now the question is your debt to income ratio. So
Yeah.
really what your debt to income ratio is how much money do you got coming in each month versus how much you got going out. So like an ideal debt to income ratio is going to be right. I mean, well, they say ultimately it's what you're comfortable with paying, like your payment, right? We can go all the way up past 50% debt to income on an FHA loan. And conventional, we're right around 45 to 46. And what that means is this, is that you take your total monthly debt obligations. And what I mean by those are like student loans. You're obligated to pay that every month. That's a monthly debt obligation. Car payment. If you have a car payment, that's something. Credit card. So you have a credit card. When you get your credit card bill, it'll say, here's your minimum payment you have to make. Now you don't necessarily, you may pay more than that, but that's the minimum. That's what will show up on your credit report. That will be used. So what we look at is what are your total monthly debt obligations? And then we look at what would be your all in, if your new mortgage payment, all in mortgage payment, including your principal, your interest, your taxes, your insurance. So we add up your monthly obligations to your monthly mortgage payment, and then we divide that by your monthly income. And that would be what your debt to income ratio is. So I have a scenario here. Let's say you have $500 a month in monthly debts, like you have a credit card payment, maybe you have a car payment, something like that. You have to pay $500 a month. Then let's say you're grossing $1,500 a month. All right. I'm sorry. Your mortgage payment is $1,500 a month, and you're grossing $5,000 a month. That your debt to income ratio would be 40%, and that would be a qualifying debt to income ratio, if that makes sense. Does that make
Yeah.
sense to you, Michelle?
Yeah. It does. Yeah. I've also
Okay.
been through it, so.
Yeah, I mean, it's pretty straightforward, but it's one of these things that we look at, and this is again for everybody. Now, the next piece is qualifying income. So the qualifying income is really, we have to be able to source and verify where do you get your income from. And the way that we do that is we look at your last 2 years of W-2s. But now, if you're not W-2'd employed, we're going to look at your last two years of federal tax returns. We're going to look at them both for W-2s as well. But if you don't have W-2s, we look at what you report as taxable income on your federal tax returns. So for qualifying income, the factors that come into play, and we're going to dig more into this, is going to be your work history. Are you full-time versus part-time? And what kind of income type you have. So let me just go into the income types that we see. And really commonly we see 4 different types. So there's W-2 hourly. That's straightforward. That means I get paid 20 bucks an hour. I work 40 hours a week. You know, it shows on my W-2 at the end of the year what I make. Straightforward. That's a W-2 hourly position. W-2 salaried, that's very straightforward as well. That means my employer says I make $50,000 a year, and I come into work. Doesn't matter really what hours I'm reporting, as much as they're paying me a salary. But on my W-2, it's going to say $50,000 a year. 1099 self-employed. These are more complicated. So for folks that are self-employed, we have to look at your last 2 years of federal tax returns, and we're going to average out the last 2 years. So we're going to average out 2020 and 2019. Now, if you made more in 2019 and less in 2020, we have to go off of the less. If you made less in 2019 and more in 2020, we're going to average the 2019 and 2020. Okay. So self-employed now, however, the one caveat is that if you're self-employed and have been self-employed for 5 years or more, we can go off of 1 year of your federal tax return for a conventional loan. If we have your accountant will write a letter stating that you've been self-employed for over 5 years. And then, so in theory, we could go off of, let's say you're self-employed, we're coming to the end of 2021, you're going to be filing your 2021 early next year. We could technically go off of 2021 if you have over 5 years, 5 years self-employment. And then the other bucket, the last bucket, which we're going to spend more time on, is W-2 hourly with tips. And I think that, you know, just to kind of go right into here, and Michelle, we could talk about this, but essentially tips are complicated. And the reality is that, as many of us know, is that you may get paid in tips, but you don't necessarily report 100% of the tips that you're getting. And the other piece is that if you want to use your tipped income as qualifying income, one, we're going to have to average it out over the last 2 years as well. So when you file your taxes, the question would be, is all of your tips showing up on your W-2 or not? If not, are you filing a separate addendums of more that you have more tips that aren't on your W-2? Because at the end of the day, we are going to have to just go off of what you've actually paid taxes on. Okay. So one thing, you know, if you're serious about buying and you're a tipped worker, you should seriously consider, if you're not doing this already, like making sure that your tips are 100% reported to your employer, so that they're putting it on your W-2. That's going to be the easiest, the cleanest way for you to do that. So I want to just stop right here. I just kind of said a lot, and I know, Michelle, you know, for folks in the service industry and your experience and all that, let's talk. So what are things
Yeah,
that are come up or questions that you know folks would have regarding this?
definitely lots on qualifying income. I guess, you know, a lot of service industry places are changing where tips are getting pooled. So when I was interested in purchasing an investment property, I actually switched to a place that was pooled, so I knew everything was going to go on my check. So if that's, you know, an option where you're serious about buying, maybe consider finding a place that does do that. But if not, if you love the place that you're working, I'd say definitely claim every dollar that you earn. But I was curious about if you could touch more on this addendum of like claiming the tips later, because I don't think a lot of people realize you could do that.
Well, again, I'm not an accountant, okay? So I would
Oh,
defer to your accountant, but I know that for taxable income, there is an IRS form to report if you receive taxes that are not on your W-2 that you can add on.
okay.
But again, I don't want to meddle in that too
Yeah,
much,
yeah.
like give advice on that. Like, but you can look into it. Like, there's definitely we've seen people do that before. But I think at the end of the day, the safest bet is going to be report it. I got to your employer, so it's on the W-2. It's all above board and clean. Um,
Okay. Well, yeah, I definitely have lots of questions just as far as qualifying income.
sure.
Service industry we are known for like basically hopping around from different restaurants, different bars. It's a weird industry where management changes a lot, restaurants go under, money could be different, seasonally. Like, for example, I was part-time over at Parsons, and that's just mainly the patio. So it's like as soon as it started getting cold, it's like all the money kind of took a dive. So a lot of people are like, oh, what am I going to do this winter? Got to switch to another spot. So with that said, let's talk about if like they're working at say 3 different places. How do you factor in all those places? Do you need to work 2 years at each place?
So yes and no. So there's a lot of there's a lot of gray in this area too. But essentially, is that if you work for multiple like different businesses, restaurants, what have you, bars, and you jump around, and maybe you haven't been at these for 2 years, but we can show a 2 years of history of consistently working in as a server, let's say, like that you demonstrate there's not huge gaps in there, then we can use your income. But again, we're going to look at the history. We're going to look at, okay, what does the last 2 years look like for Michelle Loven? Like what and we're going to look at it and we say, oh, okay, yeah, she jumps around, but she's consistently making X amount a year. That shows that there's still continuity in how you're making money. We can work with it. But if it's ebbing and flowing, we're looking at the whole year. So we're not looking at necessarily per month, like, up month, low month. We're going to be looking at how have you been reporting your income for the last 2 years. uh so you don't have to be with the same, let's just keep it simple, with the same restaurant. If you went from restaurant A to restaurant B to restaurant C in the last 2 years, but you didn't really skip. If we saw gaps, like, oh, you were didn't work for 3 weeks, like between that, we're gonna definitely need a letter of explanation. And a lot of this stuff, here's the reality, is that whenever there's gray, it makes us nervous because a lot of it is at the discretion of an underwriter. So it can be very subjective. They can look at it and say, oh, I don't it, they may want to try to poke holes in you a little bit if they feel that there's some weakness. So ultimately, if you are jumping around from different employers, we want to see that you're not having huge gaps in employment. I'm a server, I'm a professional server, and I've worked for multiple different businesses over the last few years, but I'm consistent. You don't see big gaps in there. We're not, we can work with that. But as soon as we see, oh, you're jumping around, and sometimes you work some hours, sometimes you don't, sometimes you're not, if it doesn't look stable, um, because I know a lot of servers too. Obviously, the pandemic has been a whole other game changer in this thing, but I know a lot of professional servers who they're consistent. They jump around, but they are consistent. Like they're always working, they're covering shifts, they're making their money, and even if it's from different places, they can show a pattern of, yeah, this is what I do, right? Does that make sense at all?
Oh yeah.
Um,
So I mean, like a big gap, I guess 3 weeks would be considered a big gap then. Yeah.
Yeah, you're definitely gonna have to explain that. I mean, I think we got to be careful because the reality is this. I mean, I'm just gonna be like blunt. the underwriting is going to be harder on the service industry in a lot of ways because it's the underwriter's job is to mitigate risk for the bank, right? Like, what's risky, right? Well, like, folks in the service industry are risky in nature, as we've just learned from the pandemic. Like if you're betting on like that, like there's risk. So there's that. But then if you couple that with someone who is also showing, oh, they're not they have gaps in their employment, this and that and the other, like that is even another layer of risk that you're putting on yourself. That then the underwriter's be like, wait a second, this might be a problem. So I would also just say this too, just like there isn't a one size fits all for anyone. And for anyone that's listening to this, like I would be happy to do a one-on-one consultation with you just to kind of dig in on your scenario, because everyone's scenario is different, right? It's like a thumbprint, like everyone's different. So what we could do is try to piece together a plan that works for any individual, because everyone's unique. So yeah, but short answer, you can work different jobs, you can jump around, but you just have to show that you're consistently working and you don't have major gaps.
Yeah, I guess you kind of touched on it, but with the very large gap of unemployment and the restaurants getting shut down, a lot of people ask me about unemployment and if unemployment can factor as income.
Yeah, so no, unemployment cannot be used as income. However,
Yeah.
let's say you've been a server for 3 years, COVID hit, and your place shut down. Like that gap, we're not gonna. It's like how's the best way to say it? So it's going to hurt you one way, but not the other. One way that it's not going to hurt you is that we'll be able to say, yes, like we can explain why there was a gap here. It wasn't because you decided you're not working anymore, right? That you're just taking time off. Like you went on unemployment because there was a pandemic. So we're not going to say that you haven't been a server for 2 years. We're not going to like bust that up and say that you're no longer can qualify as a server. However, what we have to do though is we have to average your pay. So if we look at a 2-year history, or if we look at the last 12 months, let's look at the last 12 months, and for 3 to 4 of them your place was shut down and you weren't working. Well, instead of having 12 full months of employment to average out, we're going to still have to average the 9 months that you did work over a 12-month period, right? So now what that's going to do is going to lower what we can use for you as qualifying income. Does that make sense?
Yeah.
So,
Yeah.
I mean, like
Unfortunate.
this is kind of yeah, I know it's unfortunate. This it's the harsh truth of what's going on right now, right? That we have to face it. And to me, that's why it's like now's the time to figure out a plan, right? Because it's tough. Folks in the service industry got hit the hardest, not only just because of what happened on the jobs and all that, but also like the ripple effect of what that means for other things, right? Like buying a home, it's more challenging, more hurdles.
Yeah. Yeah, I mean, okay, I guess like one thing that I know happens a lot with the service industry is you could be working 5, even like 6 shifts a week, but the shifts are very, like they're 5-hour shifts or something like that. So you end up being part-time. Does part-time, like the amount of hours, affect, when getting approved, or is it more just the money you bring in and it really doesn't matter?
So the way that it works is that if you're full time, which is like 35 hours or more a week, then typically we can go off of. Now again, this is tipped income is different. So in the world of all things equal, let's say you're part-time hourly and part-time and full-time hourly. Well, when you're part-time hourly, we have to show that you've consistently been part-time for 2 years. If you get a job full-time hourly, we can go off your full-time hourly job basically from day one, like once you get your first paycheck. Okay. So that is often what I see people do that are like, okay, now I want to buy a home. What do I have to do? I've been working some part-time jobs. They decide to go full-time somewhere, and even if it's for a shorter, like just enough time to be able to buy the home, and then they may go back to their old gig too. But you know, being full-time makes it just more simple to
Yeah.
to have qualifying income from a lender's perspective. But part-time, we need to just show a 2-year history, 2-year history of being part-time.
Okay. So I guess if, yeah, say, someone from the service industry is like, I'm gonna switch, I'm gonna change jobs completely, nothing to do with restaurants. Really, day one of when they start this job, this like say salaried job, you can factor that in.
Yeah, I mean, basically, we would have to wait until they got paid to actually
Right.
close on the loan. But yeah, essentially, if you got a full-time job uh, somewhere that, and then and that employer says, "Yep, they're full-time," and they're guaranteed this base hourly wage or what have you, like, yeah, then we can go off of it. Um,
Really
and which has
cool.
been a solution. I
Yeah.
mean, it's hard to do that too. I understand, but I've seen a lot of people do that. I mean, for folks in the restaurant industry, I've seen also like a server saying to the owner who they have a good relationship with and saying, "Hey, I want to buy a house. Is there any way you could just put me on salary for the next 6 months while I'm in this process to help me do that?" And here I'll just all my tips, I'll just like put them in the pot, like, or whatever, like, and I've seen that happen too. So there's creative ways that kind of goes into um the next slide. I was just gonna like, and we'll talk more about this, but like the alternatives to like, okay, gosh, like given the pandemic, I'm a tipped worker. There's just no way I need to buy now, and there's no way I'm going to be able to get my income in a position to be considered qualifying. The alternatives to doing that would be to have a non-occupying cosigner. So if you're going to buy a home, you can have someone be on the loan who doesn't live in the home, whether it's a family member, somebody who now they're going to have to provide, they're going to still have to do the application as well and show that they have qualifying income and show that they have a qualifying credit score, et cetera. But that's something that I see a lot of folks doing. And then the other point, I already kind of hit this, is if your employer can put you on salary. I mean, that's another way that um, to circumvent this as well. Again, I know that's not an option for a lot of people either. I'm not trying to be unrealistic here, but I've seen it. Like, so that's part of what I'm sharing, what I've seen. People sign on, get someone, their mom decides to help them and sign on as a non-occupying cosigner, or their employer said, you know what, yeah, I could put you on payroll in a different way while you're going through this. So
I would have never thought to like ask an employer about a different way of being paid. So I think it's a great point that you made.
yeah, I mean, it's one of those. I mean, it's a little bit. I know a lot of folks on this like probably work for smaller establishments. Like, and there's the pros and cons to that. And I mean, in a way too. I mean, I love small businesses, and now the small business. What's nice about it is you very well may have a relationship with the owner or like the real decider, right? Like if you work for a big corporation, it's gonna be harder for them to you know put you on the payroll. But if you know the owner and say, hey, this is my plan, this is what I'm trying to do, I want to stay with you, otherwise like that's the conversation. It's like, I'd rather stay here, but this is what I need to be able to do that. um and if they can do that, then you could be golden. So are there other questions, Michelle, that are coming up or that you've had? And then in a minute we can open it up to the audience for questions as well.
Let's see. I mean, I feel like we covered, obviously the big one with the gap from the shutdown. Um, I think we covered most of what comes up. Of course, like I always have some other questions if we don't have enough here.
Hey, Jess, did we get any questions come in from anybody?
Hi guys. I know you've covered a lot of info. Thanks so much for sharing all of that. One question here, could you shed some light on if it is easier at all to get approved for an investment property, or, say for instance, a condo or a single family, or is it the same experience across the board?
I mean, it's pretty much the same experience except down payment. So if you're intending to not own or occupy, you're going to typically have to put more money down. So as a lender, the lenders, the bank basically, it's all about risk. Okay. We're going to lend you money. And how risky is this loan going to be to us, the bank? Because we want our money back, right? And we're greedy bastards. We want our money. But what are risk factors? Well, one major risk factor is whether or not the property is going to be owner occupied versus an investment property. And why is that? Like, what's the risk? Well, if I buy a home to live in it, I'm going to most likely pay my mortgage on time every month because I need to live in it. Now, let's say I have my home that I live in. Now I have an investment property that I don't. Well, let's say I come onto some hard times. Which one am I more likely to let go and stop paying? The one I live in or the one I don't, right? So since the one I don't, which is the investment property, there's more risk in that. So what the bank is going to say is, well, we want you have to put more money down, because if you're going to walk away from it, we're going to make sure we get something. We're also going to have, you're going to have a higher, your interest rate's going to be a little higher on an investment property as well, because we're going to try to make that money up on your interest rate as well, just in case if you default on it. So yeah, as far as all things equal, there's not much of a difference for qualifying in a sense, but it's more just it's going to be more money down for an investment property. You're going to have a higher interest rate as well because the bank thinks it's riskier.
I'd like to touch on that a little just because of my experience. So I got approved for this two flat, and what I remember from the process was that you were able to use some of the rent, like a portion of the rent, as part of my income as well.
Yeah,
With
so and you bought that property. When you did buy that, you bought it to owner occupy, right?
yes,
And so here's the deal. Like, and this is something that's actually like awesome for first time home buyers too, that maybe you've been deciding, should I buy a single family home or should I buy a two flat, a three flat in Chicago, right? Well, when you buy a multi-unit, we can use 75% of the market rent towards qualify to help you qualify. So let's just like break it down here. So let's say you're buying a two flat, I'm going to buy a two flat, and the market rent for me to rent out the unit that I'm not going to live in, I'm going to live in one of them. The other unit, I could rent it out for $1,000 a month. Well, we could say then that you have $750 more a month. 75% of that thousand can be used to add on to your monthly qualifying income. So that's actually, Michelle, like, I mean, that's what helped you qualify, right? Because we were able to, if you didn't have that rental income for that purchase price at that time, you weren't going to qualify for that. But because we were able to use the rent, you did, right? And then you bought that property and you lived in it, you held it, and now you're moving on and you're holding it, you held it, and now it's a nice investment for you. And I think for folks who are thinking about getting into investments and whatnot, the best way to do it is buy it as an owner occupied. Go live. You need a place to live. Stop paying rent. Go buy a place. Live in it. And if you live in it and then you plan on living it for a year or more, that's great. Then you could decide, okay, now I'm going to move on to the next one. And you could do the same thing. You could buy something else. You could owner occupy it, live in it. I think you can't. You have to intend to live in it. Like, mortgage fraud is like if you were to say, "Oh, I'm going to buy this thing to live in it," and I never intended to do that. That would be fraud. But as far as things go, it's a smart strategy for people to buy it as an owner occupancy, and then decide, okay, I no longer want a three flat. I'm now want to buy a single family home for myself, and then you can hold that three flat. Now you have an investment property. Yeah.
yeah. So it's a year you have to occupy it, right?
Yes, it'll be in the disclosures you sign off saying that I intend to live in here. Now things can happen in life and things, like with people, and but it's all about your intent, right? Like what you intend to do and on that. So
Yeah. Yeah. I mean, obviously I'm pro getting investment property, and it was the way that I was able to get approved because my income was looking really strange being self-employed. So definitely something to consider about.
Jess, any other question come through?
Yeah, so we have someone asking what's more important, or I guess what maybe should be prioritized when you take into consideration income, credit score, and savings.
Ooh, yeah. I mean,
There's
I think,
something that you would, can you
yeah,
level
it's a
those?
chicken and the egg. It's like what comes first. I mean, I think ultimately credit score is pass or fail. So it's like if
Hmm.
like, you want to, I would say the you need to have a passing credit score. It doesn't have to be perfect. It could be a 600, like, and you could qualify. And then it's going to come down to your qualifying income. Um, I mean, typically for me, like I just think about the process. If you came and said, "Hey, I want to get a mortgage," I'll be like, "Great, how's your credit?" Like, and okay, great credit, great. Well, what do you do for work? So to me, it's credit is kind of like you can't pass go without a qualifying credit score. Then it's all right. Let's talk about your income. What that's going to tell you how much you could qualify in a purchase price amount. So is that like, do you have enough qualifying income to get the amount of house or property you want? And then it's like, okay, if you want this amount of house, this is the asset, this is the money you're going to need for it to be able to do it. So they're all
Sure.
together. I mean, you need them all, but I think if you don't have a qualifying credit score, I mean, you're not going to go anywhere. You can't pass go without a passing credit score. And I also just want to say too, just, you know, I think in our country, we don't like in school, like we don't learn enough about like credit, like what, like how much it matters, right? Because I think it really does. I think we take it for granted. And I see a lot of people that do a lot of just silly mistakes that could be prevented. And really your credit score really is going to impact your interest rate. Like people with great credit get money cheaper. Like it's the bottom line. So people with poorer credit end up paying more for their money. Like, and so ultimately, if you want to be financially sound and big picture, it's like, get your credit right, because you have that, it's going to really help you get a better interest rate on that mortgage. So you're paying less interest, all that. Yeah, I don't know.
Sure. No, and I think I would agree with that kind of tearing those things out. I think that makes perfect sense. This kind of leads into another good question here, and I'll kind of generalize it in regards to a co-borrower situation. If you have someone who is poor credit but good income, and a co-borrower then who is um, good credit but poor income, you have the two opposites. Um, will that balance out, or how kind of would that situation work out?
Yeah, I mean, I guess it just depends how poor the credit is. So we have to average the credit score. So the way that it works is that we have to average out the credit scores. Okay. So they recently changed the guideline. It used to be that, so let's just say, Jess, you applied, and Michelle, you applied. We pull all three credit scores from each of you. We used to use the lower middle score of the two of you. So if Michelle had, her middle score was the lowest of the two of you, so there's the three credit bureaus. Well, what's the lowest score? What's the middle score of the three? And then if there's two borrowers, we'd have to go off the lowest middle score of the two. Okay. So that in that case, it would have been moot. It's like if Michelle had more money but worse credit than Jessica, well, Michelle's worst credit was going to just bring the whole thing down regardless. Like now we average it. So if the average can still be decent enough, then you can be okay. So it's like really a case by case situation.
Yeah, that's what I was gonna
But
say. Kind of just like
but
a puzzle that you have to work through a little bit.
yeah, and we'd be happy to look at it too, just for folks like at the scenario. But ultimately though, like if you have no qualifying income and your credit isn't good, we would say it doesn't make sense for you to even be on the loan. Let your
Sure.
partner be on the loan. You can, you could still be on title to be a co-owner, but you don't need to be on the loan.
Got it. Let's see, I'm trying to interpret this question here a little
Sure.
bit, but I think what they're asking is, what if the co-signer or co-borrower you would like to use is retired?
Yeah, we do that all the time. And I mean, now my assumption is that they have retirement income. Now, if they're retired and they get Social Security, and if they're drawing off of their retirement plan, that can be considered qualifying income. So we can use retirement income, and we do that all the time.
Interesting.
Okay, cool. That looks like all the questions that we have coming in at this point, excuse me. Otherwise,
Okay.
if either of you, Michelle or Caleb, have anything else to add, any final thoughts?
Final thoughts. I just feel like if you're considering buying, you have a job, your credit is above 600, there's no harm in talking to a lender. There's just to see what you can get approved for. It's not going to affect your score as much as your credit score as much as you think it is. I think that's a big factor in people just not talking to a lender. They're terrified it's going to tank their score that they've worked like so hard to build. So yeah, that's the one thing I kind of want to leave the webinar is just saying, don't be afraid.
Don't be afraid. And yeah, and listen, if you want to talk, we don't have to pull your credit either. Like, we can have a
Yeah.
preliminary conversation just to kind of get a snapshot of where you're at. And ultimately, what we want to do is empower you with the knowledge that you need to be able to get yourself on a plan. If you're not ready now, let's give you the tools so you can be on the right path to be ready when it's time for you. So, yeah, if you need anything, hit us up. We're the Cams Jennings Group. We're an independent mortgage bank. We'd love to help you out, and we would love to work with you. And Michelle can help you find your dream home.
Yeah, and I do rentals too, so I can help rentals, I can help purchasing, but yeah, I can help with all your real estate needs.
Awesome. All right. Well, I think that's all I got.
Yeah,
Thank
I think
you
we're good.
both so much for sharing all of that.
Thank
We
Yeah,
you. Thank you
appreciate it.
both. All right. Y'all have
yeah.
a great day.